Okay, welcome to the deep dive.
Hi there.
We're going to jump into the sources you've provided specifically. This latest earnings call transcript from RBC Bearing.
Yeah, our goal here is really to unpack the key insights from this call, just like we're looking through the materials together with you, cut through the jargon.
Exactly. Get straight to what matters about their performance, market trends, and maybe where they're headed. So this is all about RBC Bearing. They focus on bearings, other critical components, mainly for aerospace and defense and the industrial markets.
Right. And we've got the Q4 fiscal 25 earnings call transcript and the related slides or materials they put out.
So our mission really is to find that story behind the numbers, see how they're navigating what seems like a pretty mixed market out there.
And figure out what their plans are going forward. Let's dive in.
All right, let's start at the top. The headline results from the quarter. What did the numbers tell us straight off?
Well, sales for Q4 came in at $438 million.
Okay, $438 million. And how does that compare?
That's up 5.8% compared to the same quarter last year. So decent growth there.
And gross margin, I saw that ticked up too.
It did, yeah. Landed at 44.2%.
Which is up from, 43.1% last year?
So, that gross margin the revenue left after the direct costs of making their stuff, seeing that increase is a good sign. Better efficiency, maybe some pricing power, maybe mix.
And then the bottom line, the number everyone watches, adjusted diluted EPS.
That came in at $2.83 per share.
$2.83. And that's adjusted EPS, so stripping out some one-off things to get to the core profit per share.
Right. And compared to last year's $2.47, that $2.83 is a pretty significant jump. It's up 14.6%.
Wow. Okay. So top line growing decently, bottom line growing much faster. That points to margin expansion.
Absolutely. The headline numbers look pretty solid. Strong performance overall.
So the really interesting part then is kind of digging into where that growth actually came from, right?
Exactly. Let's unpack that. Where was the energy in the business? Well, a big driver was the Aerospace and Defense segment. A&D, they call it.
Okay.
Sales there in Q4 were up 10.6% year over year.
And within A&D, commercial versus defense?
Commercial aerospace grew 11.6% and defense grew 8.2% just for the quarter.
Okay. But I think the full year numbers were even stronger.
Yeah, you're right. For the full fiscal year, A&D was up a full 14%.
Wow.
Commercial aero up 13.3% for the year, and defense saw really impressive growth, 15.9% for the full year.
That is really robust A&D performance, especially when you think about some of the headwinds mentioned on the call, right? Like FAA constraints, maybe slowing some production rates.
Yeah, didn't they mention a strike at a major customer too?
Yeah, exactly.
It is impressive. And the insight I think that management shared was how they managed through that. They really pointed to the breadth and diversity of their portfolio.
Okay, so not being too reliant on one thing.
Exactly. They're not tied to just one customer or one aircraft platform or even just one part of the supply chain. They do aftermarket, MRO, maintenance, repair operations. Plus, they sell to the OEMs, the big manufacturers.
Right.
And they cover fixed wing, rotary aircraft, commercial, defense. That mix kind of acts like a strategic shock absorber. Strength in one area can offset, challenges somewhere else.
Makes sense.
Yeah.
Did they call out any specific drivers within A&D, like particular programs or areas?
They did. Leading sources mentioned were sales to engine OEMs, strong demand for commercial spare parts, commercial fixed-wing programs, missiles and guided munitions, and also space applications.
Okay, so pretty broad base of strength there. What about the industrial side? That's generally been a tougher environment, hasn't it?
It really has. The overall industrial economy, measured by the manufacturing PMI, that's shown contraction for 2 years straight.
Right.
But despite that, RBC's industrial segment actually grew 3.3% year over year in Q4.
Whoa, okay. That is surprising. How did they break that down?
Within industrial distribution and aftermarket was up 2.5%, but the OEM side was notably stronger, up 5.1%.
That industrial growth is pretty remarkable then, against that contracting market backdrop. How did they explain that? What drove that outperformance?
Well, management really pointed to several things. Better service levels was one key factor, especially they mentioned at the acquired Dodge business.
Okay.
Also, just a strong internal focus, what they called a can-do attitude, basically being really responsive to customers. And then incremental progress on new product introductions finally hitting the market and contributing to sales.
So it sounds like execution, basically, outperforming the market through their own efforts.
That's exactly how they framed it, taking market share in a tough environment, really driven by organic initiatives paying off.
Okay, so let's talk about those initiatives. What specifically did they say they were doing?
Well, on the industrial side, a big focus was, like I said, improving service levels, but also the production capacity at that Dodge business they bought a few years back. They felt that was something they could fix relatively quickly and, get a pretty fast positive response from the market.
And new products.
Yeah, they also worked to capitalize on new products that were kind of already in the pipeline when they acquired Dodge, getting those pushed out.
And that Dodge business seems to be a real success story for them, doesn't it? I remember them mentioning OEM sales growth or being double digits for like the last 3 quarters.
That's right. And they finished the full year with double-digit OEM growth for Dodge.
That's huge.
It is. And management really stressed the insight here. Winning that OEM business today, that pays dividends in aftermarket and MRO sales for years down the road.
Right, the long tail.
Exactly.
Yeah.
So they see the Dodge strategy moving beyond just the initial cost cutting after the acquisition to now really driving revenue synergies, using the combined company's strengths to accelerate growth. And clearly, it seems to be paying off.
Okay. Any specific organic initiatives mentioned for A&D?
Yeah, in A&D, it was more about targeting specific customers and programs where they saw good opportunities. They also talked about just making it easier for new customers to start doing business with them. And expanding geographically, North America is their biggest market, but they specifically mentioned targeting growth in South America, India, and Mexico.
Got it. Okay, let's shift gears a bit and look ahead. What did management say about the outlook? Fiscal year 2026.
Right. The guidance. So for commercial aerospace, they're anticipating at least 15% growth.
At least 15%. Okay. What's driving that?
Primarily, it's the expected production rate increases at Boeing and Airbus. Management actually commented they think Boeing's making, quote, substantial progress under its new CEO. So that sounds like a positive signal for future rates.
Interesting comment there. What about defense? That's had incredible growth the last couple of years. Can they keep anything like that up?
Yeah, I mean, they grew nearly 22% in fiscal 24 and then another 16% in fiscal 25. Huge numbers.
Right.
But they believe they can still grow defense, at least in the mid to high single digits for fiscal 26, and maybe even more.
Even off those high bases.
Yeah. They pointed to continued strong demand from the defense OEMs, the capacity additions they're putting in place themselves, and just broad support they see for that proposed, trillion-dollar defense budget.
Any specifics there?
They did mention expected growth related to submarine programs specifically.
Okay. And industrial. You said before that's trickier to predict given the macro picture.
It is. Management acknowledged that. Harder to forecast because of, interest rates, tariffs potentially, consumer spending, GDP, all the short-term things.
Boy.
But they did highlight that the MRO side of industrial, the part supporting essential industries, the staples of human life, as they put it.
Like food and bev, grain.
Exactly. Food and beverage, grain handling, aggregate, mining, forest products, even sewage treatment. That stuff provides a pretty steady demand base, especially for their North American business.
Okay. Did they give any specific numbers for the first quarter of FY26? Q1 guidance.
Yes, they did. Q1 revenue guidance is $424 million to $434 million.
Okay, and what kind of growth is that?
That would be 4.4% to 6.8% growth year over year compared to Q1 of fiscal 25. And that assumes, the operating environment stays pretty similar to what they just saw in Q4.
Got it. What about margins? Any guidance there for the coming year?
Yeah, for Q1, they're projecting gross margins between 44.25% and 44.75%.
Okay, so the midpoint there is actually a bit higher than the full year they just finished.
Right, suggests a strong start on margins. And then for the full fiscal year 26, they anticipate 50 to 100 basis points of gross margin expansion.
So 0.5% to a full percent improvement.
Exactly. And they expect that to be more weighted towards the back half of the year.
And they mentioned tariffs in that context, right? They feel they can manage those.
They did. They said that margin expansion outlook includes managing any expected tariff headwinds, so they feel they can offset those pressures.
And what are they doing with that extra margin?
Well, they plan to reinvest some of it back into SG&A selling, general, and administrative expenses.
Okay, investing for future growth.
Precisely. To fuel those future growth initiatives we talked about.
Any other key financial targets for the full year?
Yeah, a few others. Free cash flow conversion target is 100%.
Which is strong. turning all net income into cash.
Very strong. Adjusted taxes expected in the 22-23% range, and CapEx, their capital expenditures in the range of 3% to 3.5% of sales.
Right. And I remember in the Q&A there was a question about those Boeing and Airbus rate increases.
Yeah.
Trying to quantify the revenue impact.
Yeah, someone asked for some numbers. Management did some quick back-of-the-envelope math during the call.
What do they say?
They estimated that for every 10 plane rate increase on the 737 MAX, that would add about $24 million a year to their revenue.
Okay.
A 5 plane rate increase for the 777 wide-body, also about $24 million annually.
Yeah.
And a 10 plane rate increase for the Airbus A320 family would add about $12 million annually.
So you can see how sensitive their A&D business really is to those big airframer production rates.
Definitely highlights the leverage there.
Okay, let's turn to the balance sheet.
Yeah.
How's their financial position looking? And what does that mean for, future growth, M&A activity?
Balance sheet looks very strong, actually. They paid down $275 million in debt during fiscal 2025. And that brought their trailing net leverage way down.
Net leverage being debt relative to earnings, where did it land?
Down to 1.7 turns. So net debt is only 1.7 times their trailing EBITDA. That's pretty low for this kind of company. Indicates a really strong balance sheet.
So that gives them a lot of firepower for M&A, right? Accretive deals.
Exactly. Accretive M&A deals that add to earnings per share right away. Having that strong balance sheet makes financing deals easier and, frankly, cheaper.
So what do they say about the M&A pipeline itself? Are they actively looking?
Yeah, they described it as very active, said they're working hard, looking at lots of potential alternatives.
Picky, I assume.
Very picky. They emphasized being very selective, really focusing on fit and synergy. They even said it's a, quote, big burden for the staff, which kind of tells you how much effort they're putting into vetting deals.
What kind of companies are they looking for? Especially in A&D, did they give any color there?
They did. They have a clear preference, especially in A&D, for companies that already sell to their existing customers.
Oh, okay. Why is that?
Well, the thinking is their A&D customers are sophisticated, right? Negotiating terms can be tough. So if they acquire a company that already has those relationships,
they can leverage that existing knowledge.
Exactly. Leverage the relationships, the account knowledge, reputation, how they go to market, pricing strategies. It's a huge advantage. And it adds scale at those key accounts, makes RBC even more important to them.
Makes sense. Do they mention other factors?
Yeah, they also really highlighted their own manufacturing expertise. They have like over 1,000 engineers. So they feel confident they can absorb manufacturing processes from acquired companies, quickly spot improvements, bring in their specialists. It helps de-risk deals where maybe the target's operations aren't perfect, but RBC thinks they can fix them.
And that ties back to the Dodge success story, doesn't it? Proving they can improve operations.
Absolutely. An analyst on the call even pointed that out, how impressive the Dodge turnaround was. Doubling revenue, adding over 10 percentage points to margins within 18 months.
Right.
Now, management didn't explicitly say, okay, now we're going hunting for turnaround deals, but it definitely underscores their confidence and their proven ability to extract value by improving operations in businesses they buy.
Okay, another operational point that came up was capacity. Were there constraints mentioned? Is that a challenge?
Management kind of framed it as a great problem to have.
Which usually means, yes, demand is really strong.
Exactly. Demand is outpacing their ability to produce in some areas. It's not uniform everywhere, but they said roughly 70% of their A&D revenue comes from plants where demand is significantly higher than their current capacity.
70%. Okay, so what are they doing about that? How are they trying to meet that demand?
They're actively working on it, adding labor, running more hours, so overtime, and adding machinery.
Buying new equipment.
Right. They're even physically moving machinery from plants that have some spare capacity to the ones that are really constrained.
Huh.
And they said this whole capacity expansion effort is underway now, and they expect it to continue for at least the next 2 years, just trying to catch up with the demand they're seeing.
And that connects back to the CapEx guidance, right? That 3 to 3.5% of sales.
Precisely. That investment is crucial for building those machines, maybe expanding facilities.
Are they thinking longer term too?
Yeah, they mentioned they're also planning for longer term capacity needs, looking out maybe 5 years for some plants, especially with potential defense budget increases on the horizon. They're trying to act now to get ahead of potential future demand peaks.
Okay, one last specific topic, tariffs. That came up in the Q&A, didn't it? Particularly around the new U.S. Section 301 tariffs. What was their take?
Yeah, their view was basically Short-term, probably neutral impact for them.
Why neutral?
Mostly because their existing supply chain is already heavily based in North America.
Ah, okay. Less direct exposure.
Right. But interestingly, they think longer term, larger tariffs, especially on Chinese goods, could actually be a benefit for RBC.
A benefit? How so?
Well, their reasoning is that bigger tariffs could create shortages elsewhere in the market, right, for companies relying on certain imported parts.
Okay.
And since RBC is a major domestic source for some of these products, they think they'd likely benefit as customers are forced to rethink their supply chains and look for reliable local options.
So customers might come knocking on their door.
Kind of. As management put it, the right mix will find us, meaning the business might just flow their way because of their domestic manufacturing footprint without them having to chase it aggressively. It's sort of a strategic positioning advantage.
Interesting perspective. Okay, let's try and wrap this deep dive up then. What are the main takeaways here from the RBC Bearing call?
Well, clearly strong Q4 results to finish their fiscal year.
Yeah, definitely. Driven a lot by that impressive A&D growth, which came from, diverse end markets and those specific initiatives we talked about.
And don't forget that remarkable industrial growth, especially given the weak macro backdrop, that really points to strong execution, focusing on operations, getting those new products out the door.
And the Dodge integration seems key there, shifting from just cost cuts to really driving revenue synergies.
Absolutely. And looking forward to fiscal 26, they gave a pretty clear outlook for continued growth, especially strong expectations in commercial aero and still pretty solid growth expected in defense.
Plus, that strong balance sheet gives them options for M&A.
Right. Positioned well to do deals. And they're actively managing capacity, investing now to meet the demand they see coming, even framing those constraints as a great problem to have.
So for you listening, what does this all mean? I think it really highlights how a company can outperform even in tricky markets through focused strategy and just strong execution.
Yeah, it shows the value of portfolio diversity, right? Weathering those industry storms and the long-term potential when acquisitions are integrated, well, moving beyond just cost savings to actual growth acceleration.
And maybe pay attention to how companies talk about those operational levers, service levels, new product rollouts, managing capacity. Sometimes those details can be just as telling as the big market trends.
Definitely. And maybe here's a final thought to leave you with, kind of building on this deep dive. RBC is investing heavily right now to add capacity over the next couple of years, just to meet current levels of high demand. So think about what might happen further down the line, say 3, 4, 5 years out, if or when those capacity constraints finally ease up. How could that impact their operating leverage, their profitability profile, if they have more efficient operations ready to handle sustained or maybe even slightly slower growth?
Yeah. What happens when they finally catch the demand curve?
Yeah.
Interesting question to mull over.
Exactly. Something to think about.
All right. Well, thanks for joining us for this deep dive into the RBC Bearing earnings call.
Yeah, thanks for tuning in.